Real estate investment can be a game changer for building wealth, but diving into the market without preparation can lead to costly mistakes. According to seasoned investors and industry experts, understanding the common pitfalls and learning how to sidestep them is critical for long-term success. Whether you're a first-time buyer or looking to expand your portfolio, avoiding these missteps can save you thousands and position you for growth. Mistake number 1. Failing to do market research. Why it happens. Many new investors rely on hearsay or general market trends without analyzing the specifics of their chosen location. The risk. Overpaying for a property or buying in an area with weak rental demand. Solution. Study key indicators like job growth, population trends, and median property values in the area. Use resources like Zillow, Redfin, or local government databases to assess the market potential. Example. Cities like Austin, Texas, and Charlotte, North Carolina, have shown strong growth due to tech booms and affordability, making them safer bets. Mistake number 2. Underestimating costs. Why it happens. Enthusiasm for potential profits blinds investors to hidden expenses like repairs, taxes, and management fees. The risk. Unexpected costs can turn a profitable property into a money pit. Solution. Create a detailed budget that includes closing costs, maintenance, insurance, and property management fees. Follow the 1% rule. The property should generate at least 1% of its purchase price in monthly rent to cover expenses and earn a profit. Always allocate a 10-15% contingency fund for unexpected repairs. Mistake number 3. Over-leveraging your finances. Why it happens. Low interest rates and lender flexibility make borrowing seem like an easy win. The risk. If the market shifts, you could be left with negative cash flow or even foreclosure. Solution. Stick to a debt-to-income ratio that keeps your finances balanced. Consider starting with a smaller property or house hacking to minimize upfront financial risk. Expert advice. Dave Ramsey advises keeping housing-related debts manageable to avoid overexposure. Mistake number 4. Ignoring tenant screening. Why it happens. In the rush to fill a property, landlords often accept the first applicant. The risk. A problematic tenant can lead to unpaid rent, property damage, or legal disputes. Solution. Use a thorough screening process, including background checks, credit reports, and references. Automate rent collection and late fees using platforms like Buildium or Rentec Direct for added reliability. Mistake number 5. Not having an exit strategy. Why it happens. Beginners focus on acquisition but rarely plan for when and how to sell or refinance. The risk. Market downturns or personal emergencies could trap you with a property that's hard to offload. Solution. Always have a plan B, whether that's refinancing, turning the property into a long-term rental, or selling for a modest profit. Track real estate cycles to understand when it's best to buy, hold, or sell. How to avoid these mistakes. A step-by-step approach. Educate yourself. Consider house hacking or investing in a duplex to learn the ropes while mitigating risk. Build a team. Surround yourself with professionals like real estate agents, property managers, and contractors who can offer valuable guidance. Leverage technology. Use tools like Zillow for property research, Roofstock for investment opportunities, and Mashvisor for rental performance analytics. Stay patient. Real estate is a long-term investment. Avoid get-rich-quick schemes and focus on steady, sustainable growth. Motivation. Why learn from mistakes? Learning from the missteps of others can save you significant time, money, and stress. Real estate is a proven path to wealth creation, but it requires preparation, discipline, and strategic thinking. By sidestepping these common errors, you'll not only protect your investments but also accelerate your journey to financial freedom. Take the first step with confidence. Success in real estate starts with avoiding these mistakes and building on sound strategies.